Good afternoon, everyone, and thank you for joining us today for this webinar on leveraging pension funds for affordable housing in Kenya. My name is Arth Shah, and I am the head of the Marketing and Research Department at Zamara. And today we're really excited and delighted to share with you our insights and findings from a collaborative study we've done together with CAHF, which is the Center of Affordable Housing in Africa. And this project has been partnered together with FSD Kenya. So once again, thank you and welcome everyone to this webinar. Before I begin my part of the presentation, it's very important for me to introduce to you a lot of different faces that you see in the webinar. And these are participants for the webinar who will be touching upon some part of the presentation that we will do today, and also be participating in the panel discussion that we have this afternoon. I want to first introduce Sandeep Raichura. Sandeep Raichura is the Group CEO of Zamara. He's a qualified actuary with over 32 years of experience in the pensions, social security, and investment consultancy space, gained both in UK and in Kenya. Sandeep has been involved in and contributed to many aspects of the pension conversations in Kenya. Sandeep, I can see you on the call. If you could just say hi to everyone.
Hi, everyone. Really good to be here and really excited to share the findings of the study that we've just done. Arth, it's 36 years, not 32, and I've been working for longer than your age. But yeah, really happy to share the findings of our study today.
Thank you so much, Sandeep. And indeed, yes, I'm younger than how long you've worked. Then want to introduce to you Cassia Rust. She is the Executive Director and founder of the Center for Affordable Housing Finance in Africa, short for CAHF. She is a housing policy specialist and has worked with both public and private sector practitioners in promoting access to affordable housing and housing finance in Africa. I hope having got the number of years wrong for you, Cassia, but I believe you've been in this space for the past 25 years, if not more. And she was the Housing Finance Coordinator at the Finmark Trust from 2003 to 2014, from where CAHF was actually established.
Thank you so much, Arth, and thank you, Sandeep, and the whole Zamara team. This has been such a lovely collaboration and really enabled by FSD Kenya and Sita Shah. So I've really enjoyed it and learned so much. Looking forward to hearing the comments from all the people on this call.
Thank you so much again, Cassie, for joining us today. And then I have Samuel Ondiek. Samuel is a senior advisor in the Research and Analytics Department at Zamara with over 8 years of experience working in the technology space and the financial services industry. He has over 3 years of experience in research and data analytics and has been supporting this initiative together with CAHF and FSD.
Hi, everyone, and thank you all for joining.
Super. I think here is an important slide for me to go through. So a little bit about Zamara. Zamara is a financial services company that provides actuarial consulting, insurance and reinsurance broking services within Kenya and Africa. We also provide pension consulting and administration services, also providing wealth management and financial planning services and solutions to individuals and businesses. Zamara is as old as Sandeep's career. We've been in existence for over 30 years and have been committed to making a difference and to powering prosperity, not just through our financial solutions, but by supporting research initiatives that can make a difference at a very low level, that is member level, including schemes. And we have presence in 7 countries across Africa and offices in Dubai. We have over 700 institutional clients and administer over 400,000 lives. Today's session will cover a lot of different things. We'll first talk about the current landscape of pensions in Kenya, the challenges that we're faced as an industry with respect to the uptake of pension-linked housing finance. We'll talk about the study or the survey we've done together with CAHF, the insights that we've gathered from that survey and the findings. We'll also talk a bit about global case studies that have really helped or boosted housing finance in their respective jurisdictions, and also come up with a few actionable recommendations for ourselves, that is key stakeholders in this industry and probably even policymakers. And towards the end, we'll have a panel discussion with Sandeep and Cassia talking a bit about the future of this industry and this space. Allow me to then dive in really quickly onto setting the scene and bringing some context to this webinar. As you all might have heard, Kenya is currently facing a significant housing crisis with an annual demand of 250,000 units and a supply of only 50,000 housing units across Kenya. What we've seen from research done by other parties, this has resulted in a deficit of about 2 million housing units across Kenya. And, the government aims to transform this country, trying to mitigate this deficit by turning it into an industrialized middle-income economy by 2030. And it is on this basis that you all may have heard of this affordable housing agenda that was launched in 2017. This housing agenda aims to address the crisis that we have currently forming in the country. We're also seeing other interesting statistics that really necessitate the launch or the innovation of certain products into this market, which I'll talk about shortly. And this is all poised because of the growth in population in Kenya. As a country in 1999, we had a population of 28.7 million. And by 2021, that grew to 53 million. This is an average growth rate of 1.9% in Kenya and the world average of 1.21. So we're growing faster than many other economies across the world. It is projected that by 2050, Kenya's population will double. And according to other research parties, Kenya will have a 28.5% urbanization rate, which is expected that by 2033, half of the population will be residing in towns and cities. And this will continue to exert a lot of pressure in the housing crisis that we're already seeing. In the formal sector alone, approximately 57.8% of Kenyans earn less than 50,000 shillings per month. This means that an average income earner will have a lot of difficulty obtaining houses from the market. And if we take a very good example, if one were to borrow 1.5 million shillings for 15 years at a rate of 15%, this would mean that they need to pay a monthly repayment amount of 21,000 for the loan. This is already far beyond what a middle income earner can afford to pay. And from international recommendation and research done, housing costs should never go beyond a third of one's income. From the research that we've done, which we'll share with you very shortly, we're seeing that a lot of the formal sector workers that we surveyed and that we did research on will be very unlikely to have access to houses or housing finance that they could use to purchase homes. If I was to talk a bit more about the pension industry, here's where our expertise is. The Kenyan retirement benefits industry is structured into 3 pillars. It's quite robust and we feel underutilized when it comes to housing, but the structures in place give it a lot of opportunity for growth. There are 3 pillars in the retirement benefit system. The first one is the 0 pillar. This is where cash transfers happen to elderly citizens, and this is done from the county governments. We then have the first pillar, which is the mandatory contributions to the National Social Security Fund of Kenya. We've seen a lot of talk about this, and the NSSF has grown tremendously over the past few years with changes in regulation, of course, and also increase in assets. We then have the second pillar, which is where most of the other retirement benefit schemes are held, and these are your schemes for the civil service, the occupational schemes that are sponsored or governed by trustees and other employers, and then individual and umbrella pension schemes that probably your informal sector or your formal sector who don't have schemes through their employers can save into. The pension industry over the past few years has grown tremendously at a rate of actually 12% every year for the last 10 years. It has reached an asset base of 1.73 trillion Kenya shillings. And we feel that with the increase in financial literacy, in pension literacy, and the growing mandate of the NSSF, this is only going to make the pension industry a lot bigger. Although we've seen a big increase in assets, we feel that at the moment, coverage is very low. Kenya, that has a population of about 58 million, has 19.1 million workers working in the formal sector, inclusive of the informal sector actually, where 3.3 are in the formal sector and 16.6 reside or work in the informal sector. based off this, with 19.1 million workers in Kenya, there are only 7.4 million workers who have pension accounts that they can save into. Most of these, of course, are through NSSF. And this shows us that there's still a vast majority of people in the working population that have no form of savings or don't know about it. These statistics actually illustrate both the challenges and the untapped potential within the pension sector. As Zamara, we do pension administration for schemes in the second pillar, and we administer around 20 to 25% of the schemes that are in Kenya. When it comes to housing finance, there's been a lot of change, a lot of introductions to legal provisions that impact pensions and housing finance in Kenya. If I was to summarize them, there's two that I want to talk about today. There's the 2009 mortgage regulations, which are in the Retirement Benefits Act 2009, which says that one is able to assign 60% of the pension benefits that they have as a collateral. This means that one is not able to directly withdraw 60%, but are able to access a mortgage loan based off the pension benefits. And there's been changes to that, which I'll talk about in 2020. Funds that are used in the 2009 regulations are supposed to be used solely for guarantee and collateral and not for direct withdrawal to buy a house. The houses being purchased act as the primary security with pension benefits as the secondary security. And the key benefits of this is reduced mortgage costs and reduced interest rates without members depleting their retirement savings for home ownership. This 2009 regulation is currently active. And then there was an introduction to regulations that happened in September 14th of 2020, which are currently squashed. But I think it would be important for me to talk a bit about this as well. So in 2020, there's an amendment to the Section 38(1)(a) of the Retirement Benefits Act that allowed for members to withdraw up to 40% of their accrued benefits or up to a maximum of 7 million to purchase a ready house. What this meant that they would have to actually directly withdraw their funds from retirement savings to purchase a house. There is no security here. It doesn't work like the 2009 regulation. All the monies are used for a direct purchase. There are certain key benefits to this. There's direct access to funds for home purchases. There's a simplified process for acquiring a residential house. However, we saw a lot of challenges to this, which I'll also speak about. One of them was a lot of low uptake. A lot of people didn't understand what these regulations meant. And there's a big risk of depleting retirement savings before reaching retirement. This regulations then went to court and the High Court declared it unconstitutional, and now it's quashed and no more. These have given us a lot of learning outcomes. Despite the different legislation that have come in place, we asked scheme trustees, members, and other key stakeholders of the industry what actually were the different challenges to the deterrent of using these pension-linked housing finance methods. And many of them said, there's already low pension coverage in Kenya. Why are we tapping into this pension sector to bring up housing? People have low balances. What you find is members are not able to save enough. Balances could on average range between 1 to 2 million, and that alone doesn't allow you to buy a house and also not able to allow you to retire comfortably. There was a lot of misinformation, a lot of skepticism on the regulation. There's not enough education and awareness of the different options available. There's a lot of bureaucracy that happened, and there's concerns about the paperwork, there's legal matters, the titles, etc. And then there were general constraints on affordability. The interest rates were already high for mortgage loans. Units in itself were very costly for people to buy, and low pension balances also didn't help. These challenges made us think, hey, what can the pension industry do to allow members to retire comfortably and to allow them to also have a house? So FSD Kenya then worked with Zamara and CAHF to conduct a high-level analysis of pension scheme members, including insured individuals in their life, and gain insights on what is the potential demand for housing in Kenya. Our aim was to basically find out how retirement funds can play a greater role in funding housing needs and improving access to housing finance. The research was broken down into two. Phase 1 was where we did an analysis on pension scheme members and insured lives, comprising of data from approximately 150,000 formal sector workers across various industries in Kenya. Thereafter, we did research through phase 2, which was a survey done across 6 months, gathering insights from these formal sector workers on their different needs, different barriers to access of housing finance, and their demands from housing. The study identified a lot of key barriers and opportunities, which I'll talk about, and also provides a couple of actionable recommendations that are aimed at enhancing access to affordable housing. What you'll find from the findings is that a very small percentage of workers can actually service housing loans under the current market conditions, and there's this big need for tailored loan products, reduced interest rates that could significantly expand eligibility. Part of recommendations and what we found is there's need for regulatory reforms. A lot has happened over the past 3-4 years in the pension industry, including the housing industry, and there's probably time for adjustments to the regulations so that we can create this conducive environment for pension funds to support the housing agenda. There's need for collaboration between public institutions and private sector entities to mobilize, pension fund assets to support or create the supply side of this equation. Through the analysis that we've done and the stakeholder feedback that we've received, we've charted a couple of recommendations for policymakers, for key stakeholders in the pension industry, and other parties involved with housing. Under the phase 1, which is basically an analysis, we carried out an exercise to understand how many from the 150,000 members are able to actually access a loan or are eligible for a loan, and whether there are any things that we could change with respect to the loan parameters to see whether the loan is more affordable to an individual. So in here, we basically wanted to carry out or calculate the market opportunity and how loan products need to be changed to respond to the demand side of things. We then have phase 2. Here's where we did a questionnaire to basically understand the demand for housing and housing finance across all of Kenya, which can help us engage with providers of housing goods and services in Kenya so that they can better target their solutions and also produce the right solutions for pension scheme members and wider Kenyans. I'll first go through a snippet of the results from the phase 1 analysis. The phase 1 was done with 366 employers, which had about 149,000 active members engaged in that analysis. The average age of our population was at 42.8 years. The average monthly salary of our population was around 104,000 shillings per month, and many of them, about 95% of them, resided in Nairobi. We then assumed a certain mortgage loan, which was offered to individuals aged below 60 with an interest rate of 9.5% per annum, and the maximum tenor for that loan was at 20 years, and checked whether individuals could use 30% of their salary to pay for the mortgage repayment. We found that 91% of the members were eligible for a loan. The average affordability price, that is how much on average one could afford if they were to service a loan at 30% with the interest rate of 9.5%, and that was at 2.8 million. We found that 17,725 members who can afford a loan could actually take a loan of more than 5 million. And we found that 6,146 can actually afford a loan of more than 10 billion shillings. The average age of the people that could actually be eligible for a loan was at 41.2 years. The average pension pot was at 6.9 million, and the average monthly salary was 680,000 shillings for these individuals. Most of these individuals were financial or IT sector, and that was at about 69%. What we've done here is we've mapped out the flow of how members move eligibility to being able to service a loan. Okay, so we've created a tree map for individuals that are eligible for a mortgage loan based off certain parameters, and then asked ourselves whether they are able to service that loan. Active members here are those that are in employment and actively working, and those that we surveyed in this survey. The parameters of the loan product that we chose was one where the loan eligibility criteria was one that they must have been employed or are employed, must be below retirement age of 60 years, take up a loan of 3 million shillings, have to pay a deposit of 10% of the loan amount. Here we assume that the member can make this payment through other means, if not pension savings. The loan has an interest rate of 9.5% per annum, and the tenure is 20 years up to retirement age of 60. We then asked ourselves, from the 149,000, how many have pension savings? We found that 62,704 have pension savings and 86,311 don't. From the 62,000, 60,000 are eligible for a mortgage loan and 2,000 were not eligible for mortgage loan. This could have been perhaps because they're above 60 years. And from the 60,000 that were eligible for a mortgage loan, we asked ourselves, can they service the loan? Here, the calculation we did, or the matrix that we used, was can the member pay up to 30% of their monthly salary towards the monthly loan repayment amount? You need to note that the loan amount was 3 million, and based off that, out of the 60,000 that were eligible for a mortgage loan that have pension savings, 25,000 members were actually able to service a loan, and a good portion, around 34,689, were not or are not able to service the loan. For those that didn't have pension savings, out of the 86,000, 75,000 were eligible for a mortgage loan, and only 7,500 could service the loan. Yeah, that's a lot lower than the guys that have pension savings. Another thing that we asked ourselves is, can we check how many members can service a loan, and therefore how much could they take a loan of? If they're servicing a loan of up to 30% of their salary with these loan terms, that is interest rate of 9.5% and a tenure of 20 years up to retirement age of 60, then if a loan amount or a house worth is 1 million, then how many members are actually able to service the loan? This table shows you the results. So if somebody was to take a loan of 1 million and they're able to service it, then they would appear here as a number, right? So there are 88,408 that could actually service a loan of 1 million. If somebody was to take a loan of 2 million, then only 50,727 would be able to service it up to 30%. If we look at a house worth 5 million or a loan worth 5 million, then only 17,725 would be able to service the loan using their salary. And then if we were to look at the extreme high of 10 million, then only 6,146 members would be able to service the loan of 10 million. So these statistics show you that not many people are actually able to afford and service a loan if they were to even buy a 1 million. You can see that almost 55% or 60% can only access it. And as you progressively go higher, the numbers only reduce, and up to 10 million, it's only 6,000 members. We then wanted to check how much can a member afford to pay for a house if the servicing of the loan is at 30% of salary. If we use the same loan parameters and loan terms, if one was to service a loan of up to 30% of their salary, then the average size that they could afford is only 3.9 million shillings. We then checked, are there houses in the market that are worth about 3.9 million Kenya shillings? And we found that there's 1-bedroom apartments that have an ensuite at Nairobi West that are 3.5, and this is the average result. If one was to service a loan at 20% of their salary, then they could only afford to take a loan of 2.6 million. This would get a house in 1 Road, which is at Dagoretti, and that is a 1-bedroom apartment with ensuite. And if there was individuals taking a loan and servicing that at 10% of their salary, then they could only be able to afford 1.3 million, and that could probably get them a studio house in Roysambu. This kind of shows you that the affordability of housing in Kenya is really, really low compared to the prices that we see in Kenya. We then went on to phase 2. This was where we did a survey with participants. In here, we asked the participant a lot of different questions with respect to housing, and there are a couple of many different findings that we found and recommendations based off those findings. If we look at demographics of the survey, 62% of the respondents were male where majority of them were aged between 35 to 44 years. The families on average were 4 members, which aligns with the typical Kenyan family size. This survey sample is largely representative of the database that we did the first phase analysis on, and a lot of the people were from Nairobi at about 41%, and 17% was from Kiambu, which was the next county. When it came to tenure situation, 65% of the respondents aged 35 to 45 years rent their properties. So these are primarily nuclear families with more than 2 children. And what we found from here is that younger demographic or younger individuals prefer renting due to different situations they're in. One of them being that they're building their career, they need different needs, and they require those needs to be flexible as well. Our recommendation to the industry is how can we work together to introduce affordable housing options for therefore younger families. When it came to property acquisition, 74% of the built homes came through personal or mortgage loans offered by different credit companies. 26% of the homes were purchased with the money that they have saved. Older individuals, those are between 45 to 54 years, were more likely or are more likely to own homes and have completed their loan repayments. There's a correlation that we saw from the analysis between age and property ownership. Found that younger respondents were renting, while older respondents focused on home ownership through loans or savings that they have. There's probably a need for flexible payment plans and subsidized mortgage rates, again, for younger home buyers, which is where our population is. When it came to debt servicing, 67% of the respondents repay loans, and they mostly take loans through mobiles. 51% allocate 10 to 30% of their income for debt repayment. The correlation that we found here was that lower income groups, those that have less than 100,000 Kenya shillings as monthly earnings, face financial strain due to limited savings that they have and a high debt servicing cost that they pay for. There's probably a need for us to educate our younger population and the lower income group through the introduction of financial literacy programs and having micro mortgages that favor or have favorable terms for younger and lower income individual groups. When it came to income levels, we found that 73% of households lack extra income sources. So most of them depend on the salaries that they get from the employer, and majority of them earn less than 100,000 per month. This shows us that there are income constraints. These impact savings, limit down payments for housing, and a recommendation based off this is how do we work together to provide access to affordable housing products like bonds. When it came to aspiration for home ownership, 82% aspire to own homes in the next 5 years, and they prefer urban locations like Nairobi. And we found that they preferred bungalows and maisonettes over flats and tall buildings. Here's where we saw different insights. There's limited confidence in income levels to support housing aspirations. If majority of the individuals earn less than 100,000 and their aspirations are of bungalows and maisonettes, which of course cost higher, how do we find the right balance between the two? The low-income earners prefer larger homes, bungalows, and have this really big aspirations, which probably are really hard to meet for themselves. So one thing that could happen is how do we encourage public-private partnerships to build affordable housing that meet, again, the bare minimum criteria of the low-income earners. When it came to understanding savings goals, we found that 10.4% of the respondents saved to build houses on land that they already own. So culturally, Kenyans like to own land, and it seems like the younger population are getting into this habit of saving money to build houses on the land that either they own or their ancestors own. 8.6% of the respondents save for retirement, 7.4% save for purchasing land, and 2.9% save for education. We found that savings goals are varying by age. So the younger individuals focus on housing, while the older groups prioritize savings for retirement and education for their family or their children. Certain recommendations coming from this analysis was how can we link pensions to housing by allowing limited withdrawal of pension funds and also be able to allow one to reach their dream of buying a house or building a house. From the survey, we found that mortgage rates were very expensive. Interest rates exceeded 12%, making mortgages very inaccessible for low and middle income earners. There were different down payment requirements from the analysis that we saw, and higher interest rates, which hindered housing affordability for many of the respondents that we spoke with. There's probably a need for subsidized mortgage rates and flexible payment plans for first-time home buyers. This could be potentially innovative solution for Kenya. When we asked them about government initiatives, what we saw from the respondents is there's very limited success to the affordable housing program due to different financial barriers that they're facing as low-income earners. And this was probably dominant because of high cost of construction material and inadequate incentives for developers to build low-cost housings that actually make sense. A recommendation coming out from this analysis was, how do we provide tax breaks for developers, probably lower import duties on construction material, and enhance PPPs for affordable housing. When it came to understanding the population's use of technology in finance, we know and we've seen that mobile financial platforms offer a lot of opportunities to the underserved population by providing loans, ability to access mobile money platforms and the like. It's probably a need for us to develop platforms that can assess and compare different housing finance products provided across the country and use different data that technology providers or financial platforms are gathering to assess creditworthiness of different individuals. From the analysis, again, we found that SACCOs and microfinance institutions provide flexible financings, but they face operational scale limitations. So SACCOs and MFIs that are critical for low-income earners require a lot of support to scale operations. It's probably need to strengthen SACCOs and MFIs with grants and low-interest loans, which can improve financial literacy among borrowers as well. And finally, when it came to housing preferences, majority of the individuals that we surveyed preferred 3-bedroom bungalows or maisonettes in urban areas, particularly Nairobi. Younger families prioritize larger housing units despite the financial constraints that they have. And here's the need to tailor solutions that can meet the aspirations for larger homes while addressing the affordability issues. Part of this research and the surveys that we've done, we very well understand that there are many different stakeholders that would use the information that we have differently. So we've been able to create a dashboard many different stakeholders could potentially use, and this could probably help them analyze our findings to enhance or improve the solutions that they provide. I'd love for Samuel Ondiek to show us the dashboard that we have created that we feel could be useful for the public.
Okay, thank you, Hat. I hope you can see my screen. Allow me to walk you through the dashboard presentation on the results of the residential housing market survey in Kenya. This is phase 2. We did an online questionnaire which was rolled out to general public, and we gathered responses from 47 counties. And for the dashboard analysis, today we are looking at 4 key parameters, that being demographic analysis, transport analysis, living condition analysis, and purchasability analysis. Under demographic analysis, we analyzed the gender, age bracket, industry, living condition, tenant status, and country of residence. On the transport analysis, we showcased the distance covered and time spent by respondents to work and the ownership of cars versus those who are using public transport. For the living condition analysis, we showcase the type of accommodation, number of bedroom, family sizes, mode of house acquisition, and location. And then lastly, we looked at purchasability analysis to showcase loan accessibility, household gross income, proposition of income dedicated to loan, and other sources of income for respondents. Allow me to jump into demographic analysis. In total, we had 2,045 respondents from 47 counties. And that being male respondents were 776, while female responses were 776, while male responses were 1,242. Under these demographic analysis, we looked at age bracket, tenure status, household situation, and industry. You can see that the dominant age bracket that gave us most responses were between 35 and 44 years, male being 485, while female being 286. Looking at the tenure status, those who are renting out of the total responses are 64%, while those who are owning and paying off mortgage loans are 17, that is close to 18%. And then those who are owning and have paid off the loan mortgage are 13%, while those who live rent-free are 5%. For the household situation, you see that most respondents are living with a nuclear family, that is the spouse and children. Those who are living alone became the second, while single parent was third, and then those who are living with friends became a minimal response. For the industry analysis, from the survey responses, majority indicated that they are from various industries, followed by education and research that we collected 358 number of responses, while technology gave us 1. On this dashboard analysis, we use a tooltip that could help move around to just give us deep analysis and statistics on various topical areas. Looking at the taskbar, we used filters under the gender, age bracket, industry, living situation, and country of residence. Checking on the dominant age between 35 and 44, those who are living with children, like one child, for the male respondents are 73. Those who are living with 2 children are 161, while those who are living with 3 children are 139, and 59 are living with 4 children and above. You can filter using this drop-down under gender to just see the numbers clearly. So starting with the female, you find that 286 respondents are aged between 35 and 44, and majority of the respondents are living with 2 children. Those who are living with 3 children are 66, while those who are living with 4 children and above are 20. When you come to tenure status, you can see that those who are renting and are female, you find that 114 are living with 1 child. Those who are living with 2 children are 113, and those who are living with 4 children and above are 23. The age band still, we have 25 years to 34 years and 35 years to 44 years dominating the female character here. And then for the household situation, you find that the nuclear family, for the female who are living with the nuclear family are 376, while those people who are living with friends are 3. We assume that those who are living with friends are those people who are hosting their friends who have come to look for jobs in Nairobi, and maybe in these major towns they have not gotten accommodation or settlements. For the industry, you can see that various industries take the lead under female gender, with 317 from various industries. Education and research is 130, and then technology give us 1. You can also filter that by male character, where still the dominant age bracket is 35 to 44. And you can see that those who are renting under male character are 797, which is 65% of the total respondents. Those who are paying off a loan mortgage are 210, that is around 17%. And those who are owning but have paid off the loan mortgage are 170, which is around 14%. While those people who live rent-free are close to 4%. So those people are living rent-free, maybe they have inherited the house they're living in, or they have been gifted the house, or they're living with the families, or they're living with their parents. Let's move to the next parameter, which is transport analysis. Under transport analysis, we looked at the gender, age bracket, industry, distance covered to work, and then the county of residence. You can see that majority of the respondents live in Nairobi, that is 829, as compared to Garissa all the way to West Pokot, which we had 1 response. So the approximate time take to get to work, those who take less than 30 minutes, for male character, they are 427, while female character is 265. For those who are taking between 30 minutes to 1 hour, still we have the male dominating the number by 511, while female are 302. While those people who are taking between 1 hour to 3 hours, the number keeps on decreasing. Our assumption here was that those people who are taking more hours to get to work live outcasts Nairobi, and maybe they have built their own houses or they have bought houses outcasts Nairobi. For the car ownership, you can see that close to 53% they own cars and 46% don't own cars. It's almost a ratio of 1-to-1 of those people who own cars and those who don't own cars. If you filter by distance to work, for example, those people who take those people who live 6 kilometers to 10 kilometers away from work, you can see that the ones who take 30 minutes to 1 hour for male are 105, while female are 66. For those who take like less than 30 minutes, 104 for male character and 62 for female. Allow me now to take you through the third parameter, which is the living condition analysis that shows the type of accommodation, the number of type of accommodation, mode of house acquisition, number of bedrooms in the current location, and location property. So as you can see, so many people are living in apartments, and the dominant character here are male. So for the male who are living in apartments, who are 494 in number, 24 of them are living in a bed-sitter stroke studio, while 123 are living in one-bedroom house, 238 are living in a two-bedroom house, 92 are living in a three-bedroom house, while 12 are living in a four-bedroom house. We can look even at the female character and see that the number of bedrooms for the bed-sitter, we have 8 females living in a bed-sitter, 83 living in one bedroom, 168 in two bedroom, 105 in three bedroom, and 11 in four bedroom. Looking at the current living situation is that nuclear families under female, 144 live with nuclear families. Those who are living alone are 112, while those people who are living with friends are 2. Those who are living with extended family are 23. For the mode of house acquisition, we looked at those who have constructed their houses that they live in and those who have bought the houses. We find that those who have constructed are close to 74%, which makes the number 686. While those who bought are 243, that is around 26%. The number of bedrooms in the current location, for the studio, we had 63 respondents for male. We had 231 for one bedroom, 396 for two bedroom, 330 for three bedroom, and 151 for four bedroom. This one also we can filter by the character or the gender character. For female, you can see that those people who are living in bed-sitter are 20, 104 are living in one bedroom, 245 are living in two bedroom, 247 in three bedroom, and 121 in four bedroom. 26 live in five bedroom and above. For the location of property, those who have built in rural areas, urban areas, and both rural and urban areas, 148 females have built in rural areas, and 112 have built in urban areas, while 100 have built in both urban and rural areas. If we check on the tooltip analysis, you'll find that the number of bedrooms for those who are living in apartment, 8 are living in bed-sitter, 83 are living in one bedroom, 168 in two bedroom, and 105 in three bedroom, while 11 are living in four bedroom. If we look at the tooltip for the constructed houses and bought houses, you'll find that the age band for the female character between 35 to 44 years, we had the highest number of responses, who are 70, followed by 45 to 54, who are 61. The top debts for those people who have constructed houses, you'll find that their debts goes into mortgage, and then some goes into business, and then the mobile loan. If you check on the mode of residential financing for the female who constructed their houses, majority depended on the personal loan from financial institution, which was 107. And then those who used their own cash was 119. Allow me to take you through the last parameter that we analyzed. Here we had effective demand in terms of purchasability analysis and the expressed demand. Starting with effective demand, considering access to loan, those people who consider access to loan are 76%, while those who don't consider are 23%. Those who have debt to service are 76%, while those who don't have are 23%. Having other source of income, you'll find that 73% against 27%. Amount saved for loan down payment, those people who have saved less than 100,000, for male, they are 330, while female are 212. As compared to those who have amount of down payment above 1 million, we have 159 male and 89 for female. Proportion of income dedicated to debt, you see that those who have less than 10% proportion of income dedicated to debt, 91 are male, while 56 are female. And those who have dedicated 50% and more, for male are 123 and 88 for female. Household monthly gross income, those who earn less than 50,000 for male are 199, and those who earn above 1 million are insignificant figure. Okay, let me take you through the last stage of expressed demand. For the expressed demand, those who are willing to contribute 10% on house ownership, we find that 60% are willing, while 33% are not willing. Interest to buy a house in 5 years, we have 82% who are willing, who have interest to buy a house in 5 years, while 18% are not. Ways used for housing finance, majority are using personal loans from financial institutions, while others are taking mortgage loans. A few are using on cash, while the rest are gifted stroke inheriting. And then those who are using on cash stroke personal loans from financial institutions are a significant number. Reason for no interest in buying homes, stroke building a house in the next 5 years. So many people have said that they have other financial priorities, while others are saying that they are happy living in their current homes. And then down there, you'll see some are saying they already have 2 houses. The reasons for top saving, as mentioned by Earth in the analysis that we gathered, majority of people are saving to build a house on the land they already own. A few are saving for retirement. Some also are saving to buy land. The rest are saving to buy land stroke education. Allow me to now give the mic back to Earth.
Thank you, Sam. I think very interesting statistics that I'm sure a lot of different stakeholders could use differently. There's different government interventions that have happened in Kenya. Many of them relate to affordable housing, and we've seen that the Housing Act of 2024 that has said that the cost of affordable housing, or the meaning of affordable housing, should be one where the cost of it is capped at 30% of monthly income, whether it's being paid by rent or paying for the loan. And then we've seen other interventions from the government through the housing levy, where 1.5% of gross salary matched by employers is used for a fund that is supposed to be used for building affordable housing. Just some statistics on that, by the way. The government targeted about 54 billion Kenya shillings in the financial year 2023-2024 from the housing levy to fund affordable housing program. And from the latest numbers that we have, they've collected about 54 billion. And this means that, a lot of money has been collected through housing levy. However, a lot of it is being currently used or being invested in government bonds, and a good small portion is being used for building houses. And I thought it was important to share those statistics. I'd like to now invite Kesia to give us some insights on how pension funds have supported access to affordable housing from a global perspective, and what other countries are doing.
Thank you so much. And thank you for the opportunity to come and speak to this meeting. I want to take a tiny step backwards in order to make a good step forwards in this. And really start with a framework of how we've been thinking about housing, because I think it's actually quite similar to the way in which the pension industry thinks about pensions. So that the house is a private asset. And in that context, it is something that functions for a household, either as a social asset. It's a place that you're emotionally connected to and your family is with, and it's your address in a settlement, or as a financial asset that we often think about. So it appreciates over time. Sometimes it depreciates, but it has a financial value that can be liquidated and then accessed for other purposes, or you can use it to raise a mortgage. And then lastly, a house also is an economic or income earning asset. So you can use your house as a base from which to earn an income. Pensions are similarly assets for the pension holder. Both assets are long-term assets, specifically for the long-term savings of the household. And then also for the long-term savings of the household and their ability to manage their own financial framework. We also understand the housing sector itself as a national asset. And in that context, again, like the pension sector is a national asset, it builds an asset base for the nation. And we often talk about housing as something that contributes to economic growth and job creation. I won't go into that, but I think that's fairly intuitive. And we talk about it as something that contributes to the sustainability of human settlements. So a formally built housing settlement development is a national asset, and we want to replace our informal settlements with more formal ones that meet the needs of their residents and so on. And that contributes to longer term goals, again, of economic growth and local economic development in those areas. And then finally, to think about the housing sector as a national asset in terms of its financial intermediation potential. And this is where housing and the pension industry actually meet, and the ways in which housing becomes a useful investment target for pension funds because they have the same sense of time. They're both long-term assets, and they are both relatively stable in their context. So as we think about the way in which the pension industries in different countries have engaged with this unique relationship, I think, this framework of 6 points, the private asset and the national asset, I think is worth holding on to. If you can go to the next slide, Earth. So when we think about the house as a private asset, we think often about the pension then as a form of end user finance itself, or access, to enable access to end user finance. And that's where it's tied specifically to the individual. And there are various options that exist. Yes. So broadly, the pension fund, as it might relate to thinking about housing finance and using its funding to support housing finance, the pension fund would be thinking about a benefit to its members within the framework of that long-term security, that this is a long-term asset. And there are various options. So I think the Singapore housing model is very well known for those who are interested in this sort of thing. And there, what you've got is retirement savings that become integrated in the whole financial framework for how housing is financed and supported, both on the demand and the supply side, but specifically leveraging the savings of pension holders and then allowing them to be used in specific contexts for those pension holders. Malaysia has something similar to that as well. The pension guaranteed loan is something where there's lots of experience in South Africa and also in Namibia. It's possible, as Earth said earlier, in terms of the 2009 regulations for pension-backed loans in Kenya, though the uptake is still quite low. In Malaysia, there's allowance for a direct loan to be made to members from the withdrawal benefit. So that's similar to the provision in the 2020 regulations in Kenya that were quashed. And then there are examples of the pension scheme being a lender with an asset-backed fund. Thinking more about the financial intermediation role and the way in which the pension fund is used as investment capital that would support investment in long-term residential infrastructure. There's lots of examples. And many pension funds all over the world are directly investing in housing projects. So they provide capital into a project that likely benefits their members on their target so that it can be developed over time, or investment in housing development companies themselves. Or it could be not in a housing development company, but rather providing equity into housing finance institution. There are some examples, specifically in Canada and Chile, for direct investment in a housing fund or in a public-private partnership. And then a loans facility enabled by investment into asset-backed securities. And of course, the REITs model, which exists in Kenya, in the United States, and South Africa. When we think about the different ways in which pension funds might participate, this is lovely on the demand side, right? Because it's going to help affordable housing. But it's also a real opportunity for pension funds themselves to diversify their assets and their investments and to participate in something that's in fact going to support the wider economic environment in which they operate. So the three broad areas: direct support to tomorrow's retirees, so to their direct members; investment in the housing delivery value chain at different points along the place; or a market enabling support that could build value and that then changes the overall value of the macroeconomy within which housing fits. And I think the big challenge that we can see with the data that's been presented already, on the one hand, huge affordability constraints within Kenya. Now, that's not new information, but we've been able to identify it within a cohort of people who are members of pension funds and life products. I have to say, Earth, I was not as sad, I think, as you sounded when you said there are only 6,146 households who could afford a loan of 10 million. Because if you think of the current loan book, the current mortgage lending book in Kenya at the moment, it's just over 30,000 mortgages. So that's a fifth that could participate in that way. Obviously, the dashboard that Samuel set out then demonstrated that not everybody wants the loan that they might be able to afford. But if we can imagine there are 88,000 members just of Zamara who could afford a loan of 1 million shillings that would somehow contribute to their housing process. That's on the end user side. And then you think about the pension assets themselves and the way in which pension funding can be used to unlock other funding on the financial intermediation side and supporting the housing sector as a national asset. I think there are huge opportunities for the pension industry here. And I really look forward to seeing how this research sparks more debate around what that should be in the Kenyan context. Thanks so much.
Thank you indeed, Kesia. I think you've really put a good note to us starting the panel discussion. And I know Sandeep is online. On the same breath, I think, speaking of Zamara, question to first Sandeep before I go to you, Kesia. Sandeep, we've been working on this study, and as the CEO and as a really experienced fellow in the financial services space, is there something that Zamara is doing as a key stakeholder in the pension industry to really favor, affordable housing?
Hey, Earth. Sorry, Earth, I'm speaking from my phone. I'm sitting in the car, but I hope you guys can hear me well. So first of all, Earth, thanks so much for taking us through the findings of the study so well. I believe this is an important piece. And yes, the study has given us a lot of insights on the role that pension funds can play in bridging the housing gap. And I think, Earth, for sure, it will inform a lot of our own thinking for the future. I just want to mention that the tool that Samuel presented is available, will be available, I believe, on the Zamara as well as the FSD websites. And I'm hoping that the participants will make the time to play around with it, because there's a lot of good information on it and a lot of information to inform future thinking around this. Now, allow me to also say that as Zamara, we have been at the forefront of the debate on promoting adequate retirement savings to enable retirees in our country to enjoy a good standard of living in their old age. And we recognize that in many circumstances, home ownership is a very critical element of attaining this overall goal. And as Kesia put it very well, financially, home ownership is an income stream in retirement, because in the sense it reduces the expenditure that would otherwise go towards people renting or paying off a mortgage, or even, for example, staying with somebody. And also home ownership is a good way of enhancing dignity in retirement. So at Zamara, we are convinced that it makes sense to look at pensions and housing simultaneously, and this can lead to better outcomes. If, for example, if you take somebody's pension balance, and Earth was trying to demonstrate that, whether as a loan security or even as a withdrawal, and if that can make the difference between somebody being able to purchase a home or not, then the application of the balance in this way can help to improve the individual's ultimate retirement outcome, compared to retaining the amount within the fund to accumulate to retirement. And actually, we can demonstrate this. And on the supply side, just to touch on it for a moment, if pension funds can provide long-term financing for property development, residential property, whilst meeting their return objectives, then this can be a big step in addressing some of the huge gap that we have in financing for affordable housing. Now, the challenge we have in this country currently is that interest rates are very high. Yields on government securities are much higher than what can be got on for a housing fund, and therefore a lot of pension funds and their managers will opt to just put the money in what is deemed to be less risky government securities. But however, with interest rates in the country hopefully tapering off, and we are seeing some signs of that, the appetite for housing funds or even rental funds is a good opportunity for pension funds to consider. But let me go back to ourselves as Zamara now. And yeah, I mean, again, I agree with Kesia. Yes, affordability is a big constraint, but within the Zamara database alone, we have a good number. In fact, Kesia referred to the 88,000, but even if I look at the 35,000 that Arth mentioned, would directly be able to benefit from a mortgage of the 2.5 million, that in itself is a sufficient number. It is actually bigger than the number of mortgages that we currently have in the country. And that I'm really very keen to see how we can engage with players in the industry, whether it's bankers, housing financiers, insurance companies, property developers, even the KMRC, to see how we can come up with a proof of concept that can enable us to test an end-to-end solution. So have those homes available, have the mortgages available, hopefully at a preferential rate by working with the likes of KMRC, working with legal teams to ensure that the due diligences, the vetting of properties, the preparation of sale agreements, taking out all the pain in the property purchase process. If we can work on all of that, I think we have something that we can demonstrate as a workable solution. So Arth, to answer your specific question, there's work we need to do on this, but I'm very eager for us to get on to the next step now and actually engage with players in the ecosystem on how we can do that. There's a question on the chat around, can Zamara facilitate home ownership saving? Most definitely would be very keen to talk to you. And we're also keen to engage with the government on how we can dovetail this with actually saving in the pension scheme itself. So Arth, I think, there's a lot more we can say, but let me stop there so you can have more questions asked.
Thank you, Sandeep. I think you really touched on the second part of my question as well. I think addressing affordable housing really requires a more holistic and collaborative approach, where both the demand and supply sides of the equations must be strengthened, right? I think this can only be achieved by bringing together key stakeholders like ourselves, KMRC, FSD, CAHF, insurance companies, to work towards a common goal. And I'm great that, this is something that we want to take forward as well as Zamara. For Kesia, you mentioned some of the case studies or global companies and different other countries' partnerships with, their own governments and what all they're doing. Have they really worked? Has it brought housing to be better for members there or for residents there?
Yeah, it has. There are some really interesting examples, and I think it depends on so many other factors, in the sense that you've talked about the interest rates, that those are a difficult constraint in your particular context. And in some of these contexts, it might be that the interest rate was more favorable, but I think the thing that's most interesting about the way in which a pension fund can intervene in a housing process is that by its nature, it can help itself manage the risk that is then associated with other financial flows. So an example South Africa has a very vibrant pension-backed lending scheme, and lots of people have been nervous about it because if you default on your house, you could lose your mortgage. But in fact, the incidence of that is not, I don't believe, is so significant. And what it has been able to do is assist with the flow of finance and financial flexibility to the households who do have pension savings that enable them to access that and use that benefit to secure a loan that's big enough to buy a house. So that's been very helpful. On the development side, like in terms of PPPs, there's a project also in South Africa with Old Mutual, having worked together with a developer in a neighborhood called Savannah City. And one of the things that they did was that the municipality in that area, and I think they did something similar in Zimbabwe as well, that the municipality in that area was not willing to financially able to finance in advance the infrastructure required, the bulk infrastructure required for the development to go ahead. So Old Mutual offered that funding, and on the condition that the way in which the development happened had meters that would definitely pay, where people would pay for their property rates, that a portion of that would automatically go back to Old Mutual. So they could do the kind of thing we expect a municipality to do. They funded the infrastructure up front and could structure the cost of that product to be able to receive the income on a taxation basis over time from the residents who benefited from it. I think that what's been happening, I mean, we all look at Singapore and how astonishing it is that pension savings were used there, very strong government involvement, but used to support not only households' access to housing within the scheme that had government support, but also the financing of that scheme to build the houses, themselves. And there are various examples around. And what I want this conversation, and also Earth the One, to go forward, that needs to go forward after this, to think about, is where the pension fund is enabling. So one doesn't want to reduce the value of the fund itself, or you want to be able to use that funding to support access to other funding, whether that's by the end user or by the supply side in one way or another. If I can just add one thing, I see there's a question on the Q&A from Glenn Jordan, which I'm happy to answer quickly. So they've been doing, and it's a question, Earth, you asked me earlier, about other financial innovation that exists. Because I think that the pension fund itself doesn't need to offer the product, but if it can support someone else offering the financial product, that's great. And rent to buy is something that's being explored in certain areas. And Glenn Jordan, I happen to know, he's with a company called Empower, and they're looking at ways in which to manage a rent to buy arrangement that has a long-term view, and that would allow households who don't have upfront capital for a deposit, or who can't demonstrate because they don't have a regular pay slip that they can afford to pay for a loan, that they can access it through the scheme that Empower develops. And in that case, it's not to say that the pension industry has no role in that. They have a very significant role to provide the capital to an institution that offers the rent to buy product, and that is better placed to manage the risk of a household who wouldn't be able to satisfy normal mortgage lending criteria. Where it's difficult, obviously is when there's a regulatory environment where there's constraints in terms of the regulatory environment. But I think across most countries in Southern and Eastern Africa, there is a requirement for pension funds to make domestic investments, in which case housing is a pretty good bet in that context. So I think that that's an important thing for pension funds to latch onto and to engage with. I saw also Sandeep's comment about engagement with the KMRC in the way in which that works. And I completely agree with you. I think a conversation with KMRC about how to bring together your two approaches for a very similar goal would be excellent. I'll stop there.
Thank you, Kesia. I think you've really touched upon what many different countries have done, including Kenya. This one's for Sandeep. In 2020, when the 2020 mortgage regulations had come, and they were then quashed, I think, in 2022. Do you have something for the regulator? Is there something they could have done differently to really implement what they had intended to do, right? Which was enable affordable housing. What would you then recommend that they do differently, either as a regulator or us as an industry stakeholder?
Yeah, there was a lot of debate on the merits of the change in the regulation that actually enabled members to directly access 40% of their pension account for an affordable home. Now, members obviously loved it. They wanted to exercise the option. Trustees were concerned, and I believe rightly so, not just about the added burden of implementing this, but also the potential impact on their scheme's assets, the impact on other members if there's a substantial number of members taking up this option, and how this would impact investment strategy. And there was also the wider concern on how this would impact the macroeconomy if substantial funds are pulled out of the pensions industry. And I must confess that even at Zamara, the opinion was very divided on this amendment. And so we don't necessarily have a house view on this. But looking at the principle of the matter and when what I said earlier, that considering both pensions and housing together can lead to more favorable outcomes, I think there is merit in looking at it. My understanding is, Art, that this was quashed by the courts because it was felt there was not sufficient public participation. But I believe that, a system that has perhaps the dual account like what they have in Singapore, a saving for retirement as well as a saving for housing, is a good way to look at it. And yes, if direct access is given, I feel that maybe the limit ought to be a bit lower. Perhaps it should be for a specific purpose, maybe paying for the house deposit. There ought also to be some controls around saying that, how much can be paid out from a pension fund in a year, maybe up to 10% of its assets. And there should be rules around first come, first served. I also feel that maybe there's merit in looking at something that Kesia mentioned, that I think she mentioned Malaysia, where actually you can get a loan. So I'm aware of a couple of countries where actually you can get a zero interest loan from your pension scheme that is repayable over a period, so that the money still belongs to you. You're getting a loan from the scheme. It's at a zero interest rate, so you get a home as well as hopefully preserving your pension. Now, I feel, Art, that there ought to have been a bit more modeling of the different structures before just coming up with that 40%. And I think we can offer to do that modeling. I think there's a level of engagement that needs to happen. So I feel that there's merit in revisiting that, perhaps looking at the percentage and looking at how it will be done. Just the other thing, Art, I want to say, and you touched on it as well, I feel that what we currently have in the regulation, where an individual can assign up to 60% of their retirement account for a mortgage loan, and this is like a second charge on that loan. I mean, I feel that the reason it didn't succeed was because the banking institutions, the financial institutions, were looking at the ability to pay rather than the home as an additional security. I feel, again, this is a case here where, if we can engage with the likes of KMRC, come up with a proof of concept that works, an affordable loan that meets the ability to pay requirement, then we have a good basis on which to try this out. Because I feel that 60% has worked in South Africa. We really haven't persevered enough in Kenya to make it work. And I feel that if we can overcome that interest rate impediment, then we have a basis on which we can get it to work. I hope that answers your question.
Yes, indeed, Sandeep. Really insightful from you and Cassia in this panel discussion. I think really have to stop it there. I have so many other questions, but we'll probably use another forum to have those answered. But you've done really well. So thank you, Sandeep and Cassia. I think in conclusion, we've seen that buying a home is probably the biggest financial commitment that any family will make in their entire lifetime. For first-time buyers, it is quite important that they buy something that they can afford and not spend beyond their means. And retirement benefits, just the way they're structured, they broadly have two aims. One is to enable retirees who have worked so hard over their working lifetime to enjoy now an adequate standard of living when they retire, and to also elevate poverty in old age. I think access to affordable housing or shelter is a fundamental to the achievement of these two overarching goals that retirement benefit systems have. So it's important that we see how we can link, the goals of housing and the goals of retirement together, so that we can reduce poverty and enable retirees to maintain an adequate standard of living. I want to close it there for you all. As Zamara, we will be sharing a white paper or a report based off the research that we have done that the public could consume. We will also be sharing with you all a link to the dashboard, which will be available on our social media pages. So really love you all to follow those. And if you have any questions with respect to the research or just what we're doing at Zamara with respect to housing or other matters in the financial services space, you can write to us and we can tackle it from there. Before I close, I'd love Sita Shah from FSD to give us a word of thanks and close the webinar for us.
Thank you, everyone. Can I be heard?
Yes, Sita, we can hear you.
Okay, wonderful. So thank you to Zamara for the work, to CAHF for the support. I think what we have learned is that the indebtedness is very high. The affordability is very low. We still don't know enough about whether households are willing to spend 30% on housing. What if they want to spend less? We keep learning from other research like FinAccess how large of the pocket goes to food, to education, etc. So as housing enthusiasts, we have to keep in mind that we are still not number one for the spend. And so really coming to the desire as FSD to find partners to try to create the mechanics to unlock the 2009 regulations. Sandeep used a word of perseverance. I think we need that perseverance to find and design a pilot. Also the perseverance to try to match any number of people in any pension schemes, not just the Zamara one, with potential existing supply. When we talk about the numbers in abstract, we don't know whether it's their preference, whether that housing unit from a value point is their preference, both in terms of size and location, but we can try to dig deeper to match the demand and supply better. I think one thing that really came out is Kenyans still need to rent for the reasons mainly affordability, and pension funds can play a big part in making dignified rental possible. And we're looking at how to position that so that the pension funds are not taking risk in the pilots, but if rental schemes have been matured over time, then it's responsible for pension money to come in. And also the desire for Kenyans to build on their own land to get the size of housing they want, and they've cut out all the extra costs of a developer. FSD supporting another partner in a very nascent pilot with NACHU in a large housing development called Riverline. The partners NUA, and they're creating an ecosystem, which is a tech ecosystem plus other support like standardized building plans, access to building materials to enable housing construction when it's done by a homeowner on their own plot to be cheaper and more efficient. So again, thank you to Zamara for making the findings available on a dashboard so all our stakeholders can really engage and help us take the next steps. I'm sorry we didn't open it up to the audience for questions, but we're always open for questions as we continue the discussions. Thank you so much.
Thank you, Sita. And Thank you, everyone, the participants, Sandeep, Kasira, Sam, my team who was behind the scenes, helping me with the Q&A and the chat, and everyone who attended. Thank you all.